Let's get started.
Welcome to the Financial Purpose Podcast. All opinions expressed by me or guests of the podcast are solely our own opinions and do not reflect the opinion of Life Moves Wealth Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Clients of Life Moves Wealth Management may maintain positions in the securities discussed in this podcast. Hey there, welcome to episode 78 of the Financial Purpose Podcast. Happy Monday, Wednesday, Thursday, Friday, Saturday, Sunday, whatever day you're listening to this. Happy of that day to you. I'm feeling pretty good today. We're recording this on a Monday. Just had a birthday, went over to San Diego for the weekend, saw some family, did some family stuff. Had a nice time, but very happy to be back in Arizona where the sun is shining all the time, and it's really nice. So anyway, today I want to talk about tariffs because this is the week that quote-unquote Liberation Day is happening, which is on Wednesday, April 2nd. This is the day that the tariffs and reciprocal tariffs are supposed to go into effect. And so I have some notes on what all of this is going to mean. Some of these notes are taken from a CNBC article, which is it was published on the 30th of March, which I'm recording this on the 31st, so that was yesterday. You can find this article and read through it if you'd like. It's called Trump's Promised Liberation Day of Tariffs is Coming. Here's what it could mean for you. So some of it's sourced from that article, some of it's sourced from just my own research and different reports that I get throughout the week. And the one thing I want to say about this is I talk about tariffs is, number one, it's probably going to be incomplete because tariffs are a very nuanced, very complex economic tool. They are part tax on other countries. They are part tax on domestic citizens. They are part tax on goods that we both import and buy and things like that. So there's a lot going on. The other thing about tariffs, especially with these tariffs, is that they also are partly political. And I don't play in those waters. I don't carry anybody's water, since we're talking about water. I don't care politically. I have my own beliefs, my own leanings and things that I see both socially and economically and fiscally. And that's fine. And if you're really, really curious, you're welcome to ask me and I'll share with you what I think, not on this episode, but in person or in a conversation. So I'm going to try to stay as apolitical as possible because I'm not supporting either side of any article either side of any political stance or ideology. I'm very simply just trying to report the facts because tariffs will have a financial impact and they will and already have been driving volatility in the stock market, in the bond market, and with a lot of the financial planning, short-term financial planning results for my clients. And so this is a hot topic that we're talking about. That's why I want to talk about it today. So that's the framework that we're working under for this episode. I'm going to read through these notes, and I may have some opinion inserted here or there, but otherwise I'm going to read through it. There's a lot of information here. I'm going to try to get through it as fast as possible without speaking too fast, talking over your head, sharing too many numbers that you're going to have to keep track of, and we'll see how it goes. So, all right. As Liberation Day approaches on April 2nd, 2025, the U.S. is set to implement significant tariffs that will have far-reaching effects on various sectors of the economy. So this episode will delve into the anticipated impacts, focusing largely on the automotive industry, fuel prices, lumber, and other goods and services. So over the weekend, and from this CNBC article, Commerce Secretary Howard Lutnick said that the tariffs will force other nations to, quote, show Trump some respect. The president has not really said that it's about respect for him, but he said it's about getting a better deal for our country, which he, in his opinion, has long been taken advantage of. And so he hasn't publicly defined what a better deal looks like or what it means. Now, I'm not suggesting that he doesn't know that, but he hasn't publicly declared that. He hasn't publicly declared how long tariffs would need to stay in place or how long he would want them to stay in place. He has said that the tariffs could be short-lived if he gets a good deal, but again, no guidance on what any of that means. So perhaps that's part of the negotiating tactic. Obviously, you don't let anyone know what you're thinking. That is Vito Corleone. That's important, but it's also, who knows? Obviously, other world leaders are having some strong opinions about the situation. They've issued statements on those. The tariff threat or the lack of strategy seemingly around tariffs I've talked about before in a recent episode. That situation is fracturing some relationships with our key allies like Canada and the Great Britain or England or whatever we're calling that country these days, or whatever you're calling the country, much of the European Union. So I want to talk about what the real impact of tariffs are going to be other than just like respect and getting a good deal. Because inside of that, we need to understand what's going to happen in this country or what possibly could happen in this country. Now, nobody really knows the long-term impact because it depends on how long tariffs stay in place. It depends on what reciprocal tariffs look like and such. So I'm going to start with the automotive industry because that's where a lot of the focus has kind of been around. I mean, yes, it's been partly, hey, we're trying to slow the flow of fentanyl in and out of the country. Okay, that's fine. I'm going to set that over there because I don't want to talk about fentanyl or drugs or whatever because I have my own opinions on that. But I will talk about the automotive industry. So, and that's where I'm going to focus a lot on this. In an interview on Saturday, that would be Saturday, the 29th of March, with NBC News, President Trump said it did not bother him that the tariffs caused vehicle prices to rise because autos with more U.S. content could possibly be more competitively priced. And he was quoted saying, I hope they raise their prices, they being the foreign auto manufacturers, because if they do, people are going to buy more American-made cars. I couldn't care less. If the prices on foreign cars go up, they're going to buy American cars. And they who are the buyers are going to be the American people. So the forthcoming 25% tariff on imported vehicles is poised to disrupt the U.S. automotive market substantially. In 2024, let me give you some numbers here to put this in context. The United States produced approximately 10.6 million motor vehicles, and despite the robust production, the U.S. auto market remains heavily reliant on foreign inputs and parts. In 2024, GM reported U.S. sales of about 2.7 million vehicles, while Ford sold 2.1 million units, so both representing a little less than a quarter of the total sales, but marking a 4% increase to both compared to their 2023 sales. At the same time, foreign automakers also maintain a substantial presence in the U.S. market. So Hyundai and Kia reported sales of nearly 4% for Hyundai and 2% for Kia. Those are sales increases, respectively, in 2024. And Kia, they actually have a really interesting EV and some good hybrid cars that are nice. They function very well. They have great range capacity. And so they're starting to become a little bit more of a player than maybe they used to be. So the U.S. automotive industry is a significant employer with approximately a little more than 1 million individuals working in motor vehicles and parts manufacturing. And that's as of February 2025, according to Fred data. And Fred is the St. Louis Fed department. And you can pull Fred data. Fred data is very, very dependable. It's great for a lot of economic stuff. It's insane how much data is out there, but that's the St. Louis Fed that produces that. So a little more than 1 million workers as of February. The three major U.S. automakers, Stellantis, which, side note, Stellantis is the former Fiat Chrysler company that was put together that came out of the great financial crisis. So they did a merger with Renault a couple years ago, and so it became Stellantis. So they own brands such as Alfa Romeo, Chrysler, Dodge, Fiat, Jeep, Maserati, Peugeot, Ram, just to name a few. And as a side note, after that merger was complete, BlackRock owns about 3.5% of the company. So everybody likes to bag on BlackRock. So I threw that in there just for you. So anyway, that's Stellantis. So the three major automakers, Stellantis, Ford, and GM, account for about 2/3 of the total direct employment amongst all 15 of the major automakers operating in the United States. So the implementation of 25% tariffs is expected to increase the prices of imported vehicles, potentially adding thousands of dollars to the cost of each of these cars. Even domestic manufacturers may have to raise prices due to the increased cost of imported parts, potentially adding $100 billion of annual cost to the automotive industry. That's not a small number. Now, these additional expenses are likely to get passed on to consumers because these companies will not eat the margin of these additional costs. And it potentially is going to dampen demand and potentially lead to a decrease in vehicle sales. Economist Art Laffer, or Lafer, however he says his name, in that same CNBC article, estimated that these tariffs, if fully implemented, could increase vehicle costs by about $4,700. Now, that doesn't sound like a lot of money, but when you're buying a car and you're trying to get the price down every bit you can, the thing that you have to remember is that it's not just going to increase the cost of the vehicle that you want to buy by a little more than $4,000, almost $5,000. It's going to eat into the profit margin of the dealership, because if they are selling less cars, they're going to need to maximize what they can sell those cars for in order to remain profitable enough to maintain their facilities and pay their staff and buy their inventory and do dealer incentives and things like that. So it's complicated. Not only that, but if we're tariffing these foreign cars, there are a fair number, and I think I have this later in the report, but there are a fair number of workers, and I want to say it's almost 1/3 of workers in the United States that are in the automotive industry work for a foreign manufacturer here in the United States, and most of those plants are in places like South Carolina and Georgia. And so if we're going to tariff those cars, it's possible that people right here in the United States could lose their jobs. And the whole point of the tariff is to bring manufacturing back to the United States. But if the cost of the goods don't support that, then we're actually not going to create jobs. We're going to have a net loss of jobs. And in fact, we've had a net loss of jobs a lot since the year 2000. Part of that because of the downward results of NAFTA, which then became USMCA, which I'm going to talk about here in a few minutes. In fact, let's just go right there. So did NAFTA start this problem? So the North American Free Trade Agreement, NAFTA, which took effect in 1994 under the Clinton administration, created a trilateral trade bloc between the United States, Canada, and Mexico, which eliminated most tariffs at that time on goods traded amongst the countries. So NAFTA sought to eliminate the tariffs to make trade a little more free, a little less costly. But while NAFTA contributed to the shift of auto jobs to Mexico, that was the big result. It wasn't the sole cause of what we're currently experiencing. Broader trends like globalization, automation, and corporate cost-cutting strategies also played significant roles in losing the manufacturing jobs. Additionally, the auto industry has long been a global enterprise with companies sourcing parts from around the world in order to drive down costs and remain competitive. But without a doubt, NAFTA accelerated the relocation of manufacturing jobs, particularly in the automotive sector. It reduced the production cost, which benefited the automakers and consumers because the prices of cars came down, but it came at a cost and at the expense of many American-made workers. And this was a big deal in the automotive unions and such. It caused a big shift. So in 2020, the USMCA, the United States-Mexico-Canada Agreement, was put together, again, in 2020 under the Biden administration, and I think that was started actually under the Trump administration particularly. 2020 Trump administration, and it was designed to try to fix some of the problems with NAFTA, the shortcomings of that agreement, particularly in the automotive sector, and so it required higher wage. Let's see, the agreement requires that 40 to 45% of the auto content made by workers would be earning at least $16 per hour, no matter where they were domiciled, here in the United States, Mexico, Canada, whatever. Try to equalize the wages, because naturally, and this is what happened under NAFTA, if you were Ford and you could move your plants from Detroit, Michigan, where you're subject to higher cost, pensions, the union, benefits, all that stuff, and you could move it to Mexico where you didn't have the union, you didn't have all the benefits, you could pay the Mexican workers significantly less, that's going to boost your profit margin, and so you probably make that investment. If you have to pay people a standard wage across the board, that's going to change that and potentially have a little bit more of a cost-benefit exercise where maybe you just leave those jobs domestically here in the United States. Automakers, also as a part of the USMCA, must have 75% of their parts manufactured in North America to qualify for zero tariffs, and that's an increase from 62.5% under NAFTA. Mexico, as a part of the USMCA, agreed to strengthen labor laws, particularly potentially increasing their wages and reducing the incentive for companies to relocate jobs there, which is what I was just talking about. So the tariffs taking effect on, quote, Liberation Day, which again is Wednesday, April 2nd, are in part an attempt to rebalance the trade landscape and reduce our reliance on foreign imports. Now, here's the thing. I don't know if I have it in here. I recently saw the number. Let me kind of scan. Because if I do have it in here, I want to talk about it now. I don't have it in these notes. Okay, so here's the deal. The problem with the tariffs is that for the domestic automakers, and just about everybody with the exception of Tesla, about 65% of the Tesla vehicle is manufactured in the United States. For all the other automakers, it's roughly 45-ish% of the total cars made here in the United States. So everybody is going to feel the brunt, not just the foreign car companies, but even the big three United States auto manufacturers are going to feel the weight of the tariffs, and even Tesla is going to feel the weight of the tariffs. And so the choice that these companies will have is, do we increase the price of cars, even if they are American cars? And do we send that then down to our consumers? Do we try to bring our manufacturing here back on shore? Who knows? I think the bigger question is the president's gambling that it's going to have an outsized impact on foreign cars, and so we'll be buying more American-made cars. I don't know if that's true, just because so much of the vehicles that he would want us to buy, which are from, again, GM, Ford, Stellantis, hard to say. Very, very hard to say if we're actually going to be buying those vehicles, because they're still going to be expensive. So, and quite honestly, some of the American-made vehicles aren't as great as some of the foreign-made vehicles. I'm just saying. So if you have the ability to choose, it may not have as much of an impact. So we'll see. All right, I'm going to shift now, and I want to talk about fuel, because this is also very important since we're talking about automotive. Automotives need fuel. Yes, some of the automotives, a small portion of them, are EVs. EVs still require oil to get power. I don't know how many times I need to say that. We can't make a full shift to EVs because oil still, coal power and fossil fuel related goods still power the grid that power the EVs. It's hello. We have to think about these things in general. They're not these things are not binary. It's not like we just turn off the fuel pumps and turn on the EVs. Our grid can't support it. So we have to still rely on oil in this country and really all over the world, because we are not set up to generate the amount of power it would take for everybody to have an EV and to be on their own charging schedules and whatever. So if you want brownouts and blackouts, go ahead and make the switch. Now, I will say, caveat, my wife and I, we have one Tesla that we own, and we have one diesel truck that I drive. So we've got a foot in both of the worlds, and we like both of those vehicles for very different purposes. And I don't expect that I will ever take my diesel truck and shift over to an EV truck. That's probably not going to happen. But would I have an EV daily driver and use my truck less frequently? Maybe. But now I'm buying an extra vehicle, and that's extra insurance and extra maintenance and extra tires and extra electric charging cost and things like that. So when we talk about EVs versus gas, it has to pencil out, regardless if you like Elon Musk or not. In fact, because we drove to California this weekend, you always see kind of things that from an Arizonan's perspective, you think are just like, oh my gosh, what's wrong with these people? And that is my personal opinion, right? Non-political, just as my personal opinion. People get a little looped. But I saw a lot of Teslas, as you might expect, and a lot of them had a sticker on the car that said anti-Elon Tesla Club, which I think it's dumb. I also think it's dumb if you don't have anything else to do with your life, then go protest and burn down Tesla, break windows and set cars on fire and vandalize pretty much anything. If you've got nothing better to do with your life, then go be a protester and burn stuff. Well, you're probably not listening to this podcast. So anyway, let's talk about fuel prices and oil imports. So the United States consumes approximately 20.5 million barrels of fuel per day. Petroleum is the correct word. 20.5 million barrels of petroleum per day. In 2024, the U.S. imported about 6.6 million barrels of crude oil, with Canada supplying approximately 4.3 million barrels per day, which accounted for about 65% of our crude imports. Now, 20.5 million barrels is what we consume. We can produce about 14 or provide for about 14 and a half of those. The rest has to come from somewhere else. Hence, we buy a lot of oil from Canada and a lot of petroleum. The administration's decision to impose a 10% tariff on the Canadian oil is expected to have a direct impact on gasoline prices. And given that Canadian crude is a significant source for U.S. refineries, especially in the Midwest. So where it comes down from Canada, its first stop is usually in the Chicago region. There's a major refining operation there on the south side of the city. The Interstate 55 goes right by it as you're coming into the city, just maybe a half hour south of Interstate 80. And that's going to be trying to remember the town that is south of. But anyway, it's along the Chicago River, big refinery operation. Gurnee, I think it's south of Gurnee is actually where it is. So if I'm correct. Anyway, I-55 before you get to I-80, or I should say south of I-80, there it is. And that's the first stop. So the tariffs are likely to increase production cost in that region in particular. So estimates suggest that consumers could see gasoline prices rise by anywhere from 5 cents to 25 cents per gallon, depending on the region. And the expectation is that the Midwest and Great Lakes area, which are particularly dependent on Canadian crude, may experience the most pronounced increases because that's their primary source. Gas along the Midwest comes from Canada. Gas along the rest of the country comes up from the Gulf of Mexico from other sources. And sometimes those imports, or I should say, they are imported and then they are transported between, refineries in Louisiana, Texas, all of that kind of Gulf states up to that Chicago region. So the Midwest may end up paying more for gas prices. So we'll see. So gas prices are really important because April May, June is when people start driving and traveling, and those are the heavy fuel consumption months. And so are we going to see a reduced amount of economic activity because gas prices are peaking up again? And this time you won't be able to put the little Joe Biden stickers on the pump that said I did that, because that's not going to be the case anymore. So this is going to get really interesting. I want to talk about the potential long-term impact of these tariffs, because that's really the question. So Treasury Secretary Scott Bessent suggested that tariffs would be a, quote, one-time price adjustment rather than the start of what he called an inflationary spiral. But his conclusion rests on the tariffs being brief or contained or somewhat temporary, short term, rather than leading other countries to retaliate their own tariffs, or having this be such a long term that it does turn into a long-term trade war with multiple partners who we normally will trade with. And that is going to have a downside impact on other parts of the economy. Now, Scott Bessent's a smart guy. He is very, very bright. So I've got to think, and again, he's the Treasury Secretary. I have to think that he's got a pretty good read on what's going to happen here. He has been in the financial markets his entire career. He's seen some stuff. He's worked with some legendary people in the market. He's done very good work. So I have to trust his read. But again, he is suggesting that this is the case if we have short-term tariffs. Now, at the same time, White House trade advisor Peter Navarro stated that the auto tariffs would raise $100 billion annually, which is not a short-term word. And the other tariffs in place would bring about $600 million per year, also not a short-term word, totaling approximately $6 trillion over 10 years. Not short-term words. And while this revenue could provide a substantial boost to government finances, the broader economic impact must be considered, which is what I was just talking about with cars and oil. Now, relative to the current U.S. GDP, the tariffs would represent about, 0.36% of the GDP, and over 10 years, again, not short term, would account for about roughly 3.6% of GDP. So those funds could, reduce the national debt or finance domestic initiatives, or, go to pay lobbyists or all the other bullshit that federal money goes to now, which is usually often not where it's intended to go. Tariffs often result in Tariffs result in higher consumer prices, lower economic activity. It disrupts supply chains, and it decreases international trade. So it could diminish economic growth, which is what I was just saying, especially if our trading partners retaliate with tariffs of their own. And additionally, the cost increases that are faced by a lot of industries who rely on imported goods, which are a lot of industries, could lower competitiveness, could lower profitability. And it would not be unusual to see that result in some businesses cutting jobs or maybe going out of business. And you have to think this is really widespread, because it's everything that petroleum touches, and which is so much of our lives. It's shoes and lipstick and makeup and plastics. I mean, it's just endless. And then, if people are losing, again, the United States manufacturing workforce is not a big percentage of the workforce, but it's not just the auto workers who potentially lose their jobs, but it's all of those suppliers and all of the people who make, the goods that go into just running a manufacturing facility. I mean, think forklifts and shelving units and cleaning supplies and hydraulic hoses. I mean, it's just all sorts of stuff, right? There's all these little, down the line effects that come into place. So I think I just mentioned the impact on lumber potentially. So let's talk about that. The implementation of tariffs on lumber and building materials is poised to have significant repercussions for the U.S. construction industry. It's going to affect costs. It's going to extend project timelines. And overall, it will have an impact on housing affordability, which, if you haven't been paying attention, is a major issue in this country. And not only because of where interest rates are, but because of what it costs to build a house and or buy an existing home. And so The U.S. government, again, announced a 25% tariff on softwood lumber imports from Canada. They are our largest lumber supplier. So this tariff, in addition to an existing 14.5% duty, effectively raises the total import cost by nearly 40%. That's not nothing. And the anticipation of these tariffs has already led to a 10 to 15% increase on lumber prices. Earlier in February, I had to, on my utility trailer, I had to take off the old lumber. It was rotting, it was splitting, and part of one of the boards had already just like split and completely sprung up. It almost looked like a half pipe. So I had to take all that wood off and replace it with 12 by 8s or 8 by 12s, or 8 by 12s is probably the right word. 12 by 8s, I just made myself sound stupid. 8 by 12s. And the cost of those things, I just was amazed at how much lumber cost right now in comparison to what it might have a couple of years ago. So anyway, there's a 10 to 15% increase on lumber prices. The escalation directly impacts the cost of construction projects. By the way, that trailer lumber replacement, the decking looks really good. I'm just saying. Okay. Here's the effects on the construction costs and housing prices. So the National Association of Home Builders estimates that the combined effect on tariffs on lumber and appliances, there's one we haven't talked about yet, could raise the cost of constructing single-family homes in the U.S. by approximately anywhere from $7,500 to $10,000 per home, which isn't a lot. But again, if you're already cash-strapped and because interest rates are high, and because you have to now earn more than $100,000 in a combined household to even be able to afford the basic home in this country, those costs are going to be passed on to the home buyer. It's going to make affordability a little bit more challenging. And just think, it already costs roughly $1.50 a square foot to build a house. And so if you add, another 10 to 15% on top of that, it's going to be really challenging when your home is now $1.60 or $1. I'm sorry. Did I say $1.50? $150 a square foot. It's going to be really difficult when that's now, $165 to $170 at the median per square foot to build a house. And that's going to have some implications on the construction industry. It's not just going to be borne by the consumer. But steel prices are up 15 to 20-ish%. Aluminum prices have risen 8 to 10%, all since the beginning of the year. And again, if it's cost more to build houses, less houses will be built, less people will buy the houses, more people will not have jobs. And that's not just the home builders, but that's the people who install the appliances and the electricians and the drywallers and the finishers and the painters and the roofers and the framers and all the people who supply the goods that those people use to build these houses. It just has massive disruptions here. So other places where there's going to be impact are things like consumer electronics, because a lot of our smartphones, laptops, televisions, all that stuff that is cheap. Like, I recently bought a new TV from Costco, and I was amazed at how not expensive it is to buy TVs. Why? Because they're not manufactured here in the United States and we import them cheaply, but not anymore. That's about to change. Agricultural products, which is what we always think about with Mexico. Oh, if we get tariffs on Mexico, then our avocados are going to cost more, and then the millennials won't be able to put it on their toast in the morning or whatever. But it's not just that. It's things like coffee, which directly impacts me, and fruits and vegetables and liquor, which also impacts me, because the last time Trump was in office, there was a tariff on European spirits, which meant Scotch cost more, which I have a direct problem with. Just saying. But anyways, all of that stuff that's sourced from other countries, it's nice to be able to walk into the local grocery store and there just be ample supply of things that aren't even in season right now. But there they are, because we got them from somewhere else and you can afford to buy groceries, but now that's going to get a little bit more expensive. By the way, I recently heard that the United States Customs agents and the Border Patrol from Mexico are intersecting the import of people like going down to buy eggs and trying to drive them back across the border, and they're just like intersecting and confiscating. I mean, just the number, I can't even remember what the number was because it was so obscene. The number of eggs. And they're doing that because obviously they don't want the eggs to come into the country because they could be disease borne, and then we get another like weird bird flu or something. And God knows we don't need another pandemic in this country because people lost their ever livings, and some haven't gotten them back, from COVID. But anyway, it's crazy. So just imagine what that's going to look like when you start thinking about, things like we drove on the 8th going to San Diego, and along that stretch you have dates and oranges and cabbages and onions and all sorts of crop that get grown along that corridor. And now people are going to try to go to Mexico and try to, shove it in a sock or something. They're gonna go down and buy carrots and put them in socks and whatever. I'm just guessing. Heads of lettuce are gonna come over in T-shirts and Easter baskets and I don't know what, but it's going to be problematic. And so not only that, but manufacturing equipment, which really the machinery and the parts and the goods, we get a lot of that stuff from Mexico. So that's going to be a problem. So the administration projects the tariffs could generate, again, $600 billion or so over the next couple of years. However, is that worth what it will cost the economy? And I think that's going to be a really interesting study here in a few years once we get through all of that. So since the announcement of the impending tariffs in February of 2025, U.S. stock markets have experienced notable declines, increased volatility. The S&P 500 as of today was down approximately 5.5% year to date. It did come up a little bit today. It traded down. I think it finished positive I think so. The market closed almost an hour ago. So I haven't seen the final, but anyway, down 5.5% year to date. Which is down quite a bit from the highs. Investors are really apprehensive about economic repercussions. Again, we don't understand the tariff strategy, so it looks like the things that we've invested in are going to be worth less a year from now. So sell them while you're up, let the prices go down and kind of revisit. That certainly is happening in the tech sector. The NASDAQ's down about 9.5% year to date. And so, a lot of these companies who are high growth and have been driving the markets higher over the past 2.5 years have now experienced substantial stock price reductions. And in fact, some of these high-flying companies are now in bear market territory, which means that they're below 20% from their recent high. And it's just because there's possible that supply chain disruption, increased cost, high cost of credit because right now the Fed is really hesitant to cut rates. And so just the combination of conditions really aren't great for high growth potential a year from now. And so we're seeing the value of these companies get cut. So financial institutions have responded by adjusting their economic forecasts. Goldman Sachs, for example, has raised the probability, I should say, of a U.S. recession to 35%, and they're citing higher inflation, they're citing tariffs, they're citing reduced GDP growth. For what it's worth, firms like Goldman and a bunch of the other ones, and I actually talked about this on a podcast earlier this year, back in January. They do these economic projections and price targets for like the S&P 500 and such, and their track record isn't great. So I wouldn't put a high stake in that 35% probability, because it should be noted that Franklin Templeton, which runs an anatomy of a recession dashboard, they're still showing expansion with economic data not reflecting recession risks at the moment. So again, this all comes back to inconsistency with tariff policies. We very well could get to Wednesday, Thursday of this week and not have any tariffs. They may extend some things out again. So that's just going to fuel additional market volatility. Broad reciprocal tariffs, that's kind of driven a bit of the downturn that we've had. who knows? Anytime that the tariffs come off the table, the market rallies and then they go back on and then it goes down. The president the president starts talking about tariffs, the market goes down. It gets quiet for a few days, the market goes up. So this is really, there's nothing wrong with many of these companies other than that they may have to change their financial forecast because of tariffs, but there's too much uncertainty. It's too unpredictable. It's very challenging for investors to make good informed decisions. And so we're just going to have some fluctuations at this point. We're going to have high volatility. We're going to see things bounce around. I would say, kind of as I close this up here, market volatility usually it's a short-term impact on your investments. It's a short-term impact on your financial planning. The key is how much impact short-term does it have and how long does it take to recover or get things back to normal when the market turns around. And how much of that impact really depends on how you're invested. It depends on your investment time frame. It depends on when you need money for certain things. It depends on what is required to make your financial planning work over a longer period of time versus what needs to make your financial planning work over a short period of time. If you'd like to get a second opinion on where things are currently for your investments and for your financial plan, please send an email to info@lifemoveswealth.com or go to lifemoveswealth.com and click the schedule time with me button, I think is what that actually says. It's down on the lower right. It's a little kind of oval shaped schedule time with me button. Click on that. It's going to take you right to my calendar. You can pick the best day and time for you, and we'll talk about anything that you want to talk about: financial planning, investing, potential for how we navigate any of this sort of tariff or uncertainty, unpredictability induced market volatility, what you might need to look at, what investment strategies might make sense, what needs to shift in your financial planning. And if you're a business owner, we probably need to talk about what potential things you might need to do in the business to make the business continue to be profitable and a little bit more recession-proof if we do see some slowdown, if there are some disruptions in your supply chains and maybe in your consumers' buying patterns. Let's have that conversation because that's going to have a direct personal financial planning impact on you as the owner and potentially on your employees as stakeholders in that business. So let's have a conversation that makes sense about those things. Let's do it the right way. And again, an email over to info@lifemoveswealth.com or head over to lifemoveswealth.com and click that schedule button. So that's all I have for you this time. Maybe this time next week, we'll have a lot more color on what's happening with tariffs and what's next, and we'll see. But in the meantime, go be financially awesome. Business owners, go be a boss. Check out the boss method at lifemoveswealth.com. And until the next episode, take care of yourselves. See ya. Thanks for listening to this episode. Be sure to like, subscribe, and share. To learn more about your financial purpose, visit lifemoveswealth.com.